much. So Elixir Capital is a growth equity fund. You met a number of people who are on the seed stage and early stage side. We tend to follow on after those guys. We tend to invest between 2 to 6 million, approximately, generally. We just closed, so we are in pretty much every way a brand new fund. We have a fund size of about 150 million US. We focus in Southeast Asia. We also tend to focus on a number of industries that have already been mentioned. But one of the things that I think differentiates us a great deal, we tend to be very exit focused. One of the things that we do, and one of the reasons why we have an office here as well as in Southeast Asia, is because we work with the corporate development teams, the M&A teams here, to find M&A opportunities in Southeast Asia. So that's one of the things I think that differentiates us, our fund, from many of the other funds. We tend to, again, be later stage investors. Lastly, our target markets, just because of the size, we tend to look at Indonesia first, but we also look at other countries in the region.
So it's typically quite common for Southeast Asian investors to be very early stage focused, but you guys are clearly later stage, right? So where did you guys see the opportunity and why did you decide to focus on the later part?
So you may have heard a lot of Series A or Series B or seed stage. We don't tend to look at the landscape in that way. What we look at is really where the company is in its growth. We look for a few key characteristics. Number one, that the product development is done. In other words, there is no development risk. So that could be a round, it could be a lot later. That's one very significant factor. The second significant factor is that we tend to focus on companies that have put the product out on the market. So the product is already making money. The company doesn't have to be profitable, but it's on the market. And then lastly, we also tend to focus on companies that have teams that are essentially fully formed. There may be small holes, maybe a CFO, for instance, or so on, but the teams are generally well formed and have some history of working together and developing the product. So we look at it as right before the inflection point of growth comes in. We are growth capital. Our capital is all about scale. And you'll see that a number of the other investors here talked about the fragmentation in the market in Southeast Asia. That's really what we are addressing. We're focused on growth because one of the reasons why we feel that US companies in particular will be interested in the Southeast Asian market is scale. US companies, they're now increasingly looking abroad for acquisitions. You're seeing just the tip of the iceberg, but the companies need to be big enough to be worth acquiring. And so the problem that you see here is not one of is the ecosystem there or anything like that, or are there enough candidates? It's scale. And when the companies are large enough, they will become targets.
So at this stage, I mean, based on your experience talking to a lot of these corp dev teams, right, is there an interest from value-based companies for Southeast Asia?
Absolutely. So value-based companies, so you have to look at it from a macro perspective. So one of the first things that you'll realize, and a great example of this is Apple or Google. A huge percentage of their profits, of these tech companies' profits, are actually from overseas, not from the US. And that's increasingly been the case. Now, what's interesting is that many of these tech companies have structured their profits offshore. And Apple has been criticized roundly for that tax-efficient structuring. But it's not just Apple. Lots of these companies have done that. Now, interestingly, that puts a very interesting incentive for acquiring abroad. So if a company in the US takes that money and brings it to the US to acquire a company, they're immediately taxed on it. Versus if they go and use that money abroad to acquire, there's essentially no tax penalty for that, right? So immediately you'll get a higher ROI just because you're able to use the capital more efficiently. So imagine if you're a public company, the last thing you want to do, particularly in tech, is return capital. You don't want to do a dividend. You want to keep that capital. And that's what tech companies tend to do. But what you're seeing is that now with the M&A side, it's much more efficient for them to actually acquire abroad than it is to acquire in the US. It's actually in many ways cheaper at the end of the day to acquire abroad. Now add to that the opportunities in Asia. Consistently, there's been very consistent growth, and I think tech companies have realized something that they didn't realize 5-7 years ago. They realized that if they don't enter the market, particularly say in China, that they will lose the market. And so you'll see companies that in the last 10 years have been extremely successful in China. And you're seeing companies in the US saying, you know what, we could have been there. We could have been that company. We could have had that growth. And so you're seeing increasingly Silicon Valley companies being very acquisitive and looking abroad. But it has to have enough scale. So that's going to be one of the key issues as we move forward.
So who do you think are the top 2 or 3 companies in the valley that is really looking at Southeast Asian heavily?
That's something I can't share just because of whom we're working with. But I can say I can point to certain industries that I think are going to be very important. I think the payments industry, as was mentioned, is going to be extremely important. I think the online marketplaces are going to be very important. I think the advertising industry, online advertising, is also going to be very increasingly important. We like those industries a great deal. Now, other companies, so let me step back for a moment because I think this is an important differentiator. We love tech companies. We don't invest only in tech. What we focus on are what we refer to as tech-enabled companies. And what I mean by that is that there are lots of companies that can use technology to change the nature of the business, but they're not per se tech companies. A good example is logistics. Logistics is as old as society is. It's moving one thing from one place to another. The application of technology to logistics, geolocation, back-end inventory management, all of these technologies changes the nature, changes the profitability of these industries. These types of things we call tech-enabled industries. And that tech-enabled sector we think is going to be very important. So logistics is actually something that we're quite interested in these developing economies. Another theme that we like to pursue is piggybacking on the consumer growth in these regions. So retail is also something that we're very interested in, particularly as these markets are liberalized. There are significant restrictions on foreign retailers coming in, online retailers and so forth. So we like those sectors. But I can say that there's a great deal of interest in these areas. We work with many of these companies, both the corp dev and the M&A teams, and part of that is our own secret sauce of being able to see where the opportunities are.
If you look at public markets in Asia, right, like mainly the Tokyo Stock Exchange and the Australian Stock Exchange, which are 2 big ones that are focused on tech media companies, right? Do you see the likelihood of Asian-based companies, taking that as an exit route?
We look at an IPO as great. We don't actually plan particularly for IPOs for two reasons. One is that there are dependencies that are different from the company. These are separate from the company that have a big effect on the price of the IPO. So those are outside of the company's control largely. So it becomes hard for us to plan. So that's one significant problem. The other is that honestly these markets are not that large when you look at it. In terms of local tech companies and companies in Southeast Asia doing IPOs, the valuations have not been that great. So taking that into consideration, we look at that as an opportunity. We'll certainly look at that, but we look at M&A opportunities, particularly by US companies, as much more significant and within our control. And frankly, most of these tech companies, and I think you'll share this, are probably going to pay more for the right opportunity than the IPO market.
Questions? Do we have questions on the floor? Anyone so far?
So I have a question for you guys. Who here thinks they're in a growth stage company? So what makes you think that it's growth stage?
Yeah, I mean, you mentioned we already have the product. It is earning dollars, and you're getting inbound leads. So that's how I see that we have something that people want and we are willing to pay.
Yeah, and so that's interesting to me because we don't care if we're the first investor or the fifth investor. It's where that inflection point is. And so what I see as a big hurdle in the region is that you see a lot of Me Too companies, but that's fine as long as you have market share. As long as we can, what we do is build companies to an exit. So what we add is the managerial talent, and the wherewithal of how to essentially get into an acquisition or get acquired by a large public company. And we've done it before, and we were in other funds. The principals were in other funds doing exactly that, and it's a very different skill set than early stage, seed stage investment that, for example, many of the guys talked about here. And then a follow-up question. There was one other person that had growth stage, who's in a growth stage company. Who else? Oh, I guess got to get a bit gun shy. But I think there are opportunities. And by the way, we're not looking at just companies. We're just single companies. We're also looking at carve-outs. We're happy to go and get our hands dirty of carving out specific businesses from large conglomerates and funding those.
So in the US, right, it's always about growth and a bit less about revenue. So people value, I think there's high regard for larger market share, but a lower amount of revenue, right? Whereas in Asia, in a lot of cases, the revenue aspect is very important. What is that, in your perspective, which one do you think is the right way?
Revenue to me is one of many indicators. Growth is one of many indicators. You can't look at one and say that's going to be the key characteristic. It heavily depends on the businesses. But I think what we are seeing is that market share becomes very important to potential acquirers. Because, contrary to some of the discussion, and perhaps I'm in the minority here, but in our experience, US companies and foreign companies in general are not acquiring, for the most part, not always, but for the most part, they're not acquiring companies in Southeast Asia for IP, period. They're acquiring them for market share. They're acquiring them for sales. They're acquiring them for people. They're acquiring them for other reasons than IP. And that's a very important differentiator because we don't really invest in IP, we invest in people and we invest in market share. So if someone has Me Too IP but has excellent market share, we're probably very interested in that company. And because we know that US acquirers are going to look at it and say, we can piggyback on the customer base or the targets that they already have. And that is going to be one of the key factors.
IP has been brought up multiple times today, right? Why do you think in Asia, right, IP isn't that valuable?
Partially it's because a lot of the guys who work deeply on IP leave Asia. They come here or they go somewhere else. So if the critical mass isn't there. And I think what you see is that because of one of the most interesting opportunities we see is in these conglomerates, we see great IP, but it has been underutilized. It hasn't been nurtured in a way that it would be nurtured here. And not to say that it's perfect here, but I think there is a greater emphasis placed on it here, both within large companies and smaller companies. And that could be because of a lot of reasons, but I think that the ecosystem needs to change significantly for it to become a dominant factor. I think it's a factor, but it's certainly not the dominant factor.
One last quick question.
So, on the point of IP though, I think depending on what stage the company's at, that can be a very tricky thing to balance because if you're really small, you're very early stage, you're bootstrapping, the cost of securing your IP internationally can be cost prohibitive.
Go get customers That's the most important thing. Go get revenue. That's the more important thing. You know,